All right, welcome back. So, the trading week just wrapped up. It's Friday, February 13th, and boy, did it leave us with a fascinating puzzle. You've got US markets flying high, Asia taking a bit of a nosedive, and Europe, well, Europe is split right down the middle. So let's dig in and figure out what's really going on here.
Yeah, so this is the big question, isn't it? US up, Asia down, Europe split. What's the real story behind these numbers? I mean, why did the US rally so hard while Asia just stumbled? And what's going on with Europe? You know, these aren't just random blips on a screen. There are some really powerful forces at play here, and that's exactly what we're going to uncover together today.
Okay, so today's global market snapshot. Let's take a look at the closing bell for February 13, 2026. Before we get into the why, we've got to start with the what. So let's look at the hard numbers that really define the day.
And here we go. This is really where the story starts to come together. Just look at this. You can see the US indices, right? The S&P 500, the NASDAQ 100, both closing in the green. But then you glance over at Europe and it's a completely mixed bag. The UK's FTSE is up, but France's CAC 40 is in the red. And then Asia, wow, the picture there is pretty clear, with Hong Kong's Hang Seng taking a real hit. You see, these numbers, these are the clues we're going to follow.
All right, so we've got the numbers. Now for the fun part. Let's uncover the stories behind them. It turns out there are really three core narratives that shaped everything today. And believe me, understanding these is absolutely crucial. So let's start with this. This one number right here basically set the entire tone for the US market today. 2.4%. What is it? That was the January inflation reading. And honestly, it was the signal investors were holding their breath for. And this really tells the story of the impact. That 2.4% figure, I mean, yeah, it's still a bit above the Fed's target, but what it showed was a clear cooling trend. It was that perfect Goldilocks number, you know? Not too hot to make the Fed panic and hike rates, but not so cold that it screamed a recession. It just calmed everyone's nerves and was exactly what the market needed to rally into the weekend.
Now, inside the US market, something really interesting is happening with tech. It feels like the whole AI hype phase is maturing. It's turning into a search for actual, real value. So investors are kind of sorting companies into two big buckets now. In one bucket, you've got the enablers. Think Applied Materials, the guys who make the actual hardware for AI. They absolutely soared today because their growth forecast was so strong. But in the other bucket, you've got companies like Cisco, where the market is worried they might get disrupted by AI. See the difference? This isn't just about buzzwords anymore. It's about real-world utility.
Okay, let's hop over to Europe because you can see this theme building. What happened today was a perfect example of the two different stories playing out on the continent. In the UK, the FTSE 100 got a nice lift, mostly from defense and aerospace companies. That's a story of resilience, right? Especially with the current geopolitical climate. But then you look at France. The CAC 40, which has a lot of luxury brands, was dragged down. Why? L'Oreal took a hit after their sales numbers in China missed the mark. So you've got two totally different economic engines driving two totally different outcomes. It's fascinating.
And that finally brings us to Asia, where, well, investors were juggling a whole bunch of challenges. We saw folks taking profits in Korean tech. Hong Kong was feeling the pain from some weak property data out of China. And of course, markets on the mainland were pretty quiet ahead of the big holiday. Now, there was one little silver lining. A report about a pause in the US-China tech tensions. And honestly, that probably saved things from being even worse. But still, the overall vibe, definitely cautious.
Okay, so that's the story of today. But what about tomorrow? I mean, what happens next? Well, the analysis we're digging into also has a data-driven forecast for the rest of the month. Let's go ahead and see what the models are predicting.
Looking at the US, the forecast is pretty optimistic. It's pointing to continued positive momentum. The Dow is actually projected to cross that big 50,000 mark, and solid gains are expected for the NASDAQ and S&P 500 too. And what's fueling all this optimism? It's the belief that the cooling inflation trend we just talked about is going to stick around, giving the market more room to run.
But check this out. The real standout projection is this one right here, a gain of almost 4% for the Philadelphia Semiconductor Index, or the SOX. So here's the key point. This isn't just broad, general market optimism. No, this is a very specific bet on the semiconductor sector. And it's all being fueled by the insane demand for those next-gen components, things like HBM4 memory and advanced packaging for AI.
Now, when we look over at Europe and Asia, that fragmented picture, well, it's expected to continue. The UK's FTSE, it's projected to keep climbing, powered by those same defense and energy sectors. And good news for Asia. Markets like Korea and Hong Kong are forecast to see a really strong rebound. But Look at France's CAC 40. The forecast suggests its struggles are going to continue. That's a pretty strong signal that the issues facing luxury brands are way more than just a one-day blip.
So the big question is, how on earth do you navigate a market this fragmented? Well, the analysis we're using actually lays out a pretty interesting quant-based strategy. And I have to be super clear here. This isn't financial advice. We're just explaining the logic behind this specific model-based approach.
Let's break down this three-step approach. First up is something called a long-short pair trade. It sounds complicated, but it's really just about betting on that divergence we've been talking about. You'd buy stocks you think will go up, like our AI enabler, AMAT, while at the same time shorting stocks you expect to go down, like Cisco. Makes sense, right? Step 2 is volatility hedging. Just think of this as buying insurance for your portfolio. It means using tools like VIX options to protect yourself from any sudden, unexpected market shocks. And finally, step 3 is an institutional carry trade. This is a classic move. You borrow money where interest rates are super low, like in Japan, and then you invest it where you can get a higher potential return, like in the Korean tech sector, which the model thinks is undervalued right now.
This quote from Günter Dueck, I think it just perfectly captures the spirit of what's happening right now. In the new economy, capital flows towards resilience, not just efficiency. We saw that today, didn't we? We saw it in the strength of the UK's defense sector, and we saw it in the market rewarding AI companies that build real, solid, resilient infrastructure. It feels like the old model of just chasing efficiency at all costs is being challenged. Today, it seems resilience is king.
So, if there's one thing to take away from all this, it's that we are watching a complex pivot happen in real time. The market is rewarding tangible utility in tech and resilience in industry, all while navigating this new inflation landscape. And these aren't just one-day trends, they are the themes shaping the future. So, the real question for all of us is, what will you be watching next week? Thanks for joining me for this breakdown.